Welcome to Financial Wellbeing with Emirates NBD. I'm your host, Dana Kamber. Today's episode covers the fundamentals of investing, from mindset to understanding the market and assessing different strategies. I'm joined by Maurice Gravier, Group Chief Investment Officer at Emirates NBD, a true expert on wealth building with incomparable knowledge to share. Welcome, Maurice, to the podcast. Thank you for being here with us today. I'm going to start off with, how does investing differ from savings?
It's a good fundamental question. Saving is first the discipline of not spending everything you have, and then your savings are something that you keep safe and accessible. You don't take risk on saving. You save for, your next holiday, for an emergency fund, which is very important, or for maybe buying a handbag next month. Investing is different. It's on a longer time horizon, which unlocks the potential of various asset classes to generate much higher returns. So it's a longer term game.
So you mentioned different asset classes. Can you elaborate a little bit on them?
Oh, yes, of course. That's very fundamental, and that's something that is often overlooked. So first is cash and cash-like, which means money markets, deposits at the bank, this kind of thing. So this is low risk, highly liquid. You can access to it all the time, but of course, low return. Second family of investments, second asset classes, the fixed income world. In this case, you buy a security, a bond typically, that lends money to a government, to a company, whatever. So it's a longer time horizon as well. It's a higher return. You lend money and you get yields, you get interest rates on your loan, which are linked to various factors. The length of your loan, of course. You get more money if you lend over 20 years than over 6 months. And also the risk that you take with the issuer. If you lend money to Switzerland, you will get zero. If you lend money to a small company in, biotechnology, you will get much more. That's the credit risk.
And the fixed income you mentioned are bonds.
Bonds, yes.
Okay, and
absolutely.
bonds are like loaning money.
Bonds, you buy a security, which is a loan to an issuer. And government bonds are a big part of the market. That's, you lend money to France, to the US. The US has, $30 trillion of debt. This is treasury bonds that you can buy. Interestingly, the fixed income also exists in private markets. I will not go into too many details, but what we do mostly is public market, which means listed on a stock exchange. So you can buy and sell. You have a price pretty much all the time. But it can also be a private market. So first, cash and accumulate, low risk, low return, highly liquid. Second, fixed income, which is a bit more risky, but not that much, because at the end, if the government usually pay you back, and if the company is in trouble, you have a priority compared to other investors which are equity, the third asset class, and I would say the king of asset classes. So equity, you buy a stock. So you are the owner of a fraction of a company. Here it's not governments, obviously, it's a company. You are the owner, which means that you have a right on the company's profits, which can be distributed through dividends. And of course, the value of your stock is linked to the value of the company because you are the owner. So if the company grows and its market values grows, you are directly impacted. That's the highest risk, because if things go bad, of course, you may end up with nothing. As simple as that. It's also the highest return because you are directly involved in this entrepreneurship and in the growth of the company. Again, we are talking about listed markets, stock markets, but it also exists in the private assets. We talk about private equity. Private equity, it's not that you buy a stock of, Amazon. It's that you invest in your cousin's startup, for example, or through funds who do that. So third asset class is equity. Highest risk, highest return, and highest volatility, which means that over the short term, the prices can fluctuate a lot. Over the long term, much less. Then the fourth family of asset classes are what we call alternatives. So it's everything else, let's say. It includes commodities. For us, in our asset allocation, we have gold, for example. It behaves differently from the rest, which is the benefit. You also have real estate. Again, it can be listed. It's REIT, Real Estate Investment Trust, or not listed. I mean, you buy a building or you buy a part of a building. And finally, hedge funds. Hedge funds are actively managed strategies. You have people who run your money and they are looking for absolute return. So they try to generate 5, 10, 15% per year, whatever happens. But I know I'm long, but what matters? So you have four asset classes. for families, cash, fixed income, sukuk, equity and alternatives. But what is important is not just their individual behavior. I listed them from the less risk return to the highest, but it's also how they behave together, because they don't behave the same way, and that's how you build a portfolio.
Yeah, no, you were long, but actually very insightful. So thank you for that. You mentioned quite a difference of terminologies throughout your response. So what are a few things that people need to know, like let's just say things around margins, leverage, and things of that sort?
That's interesting that you mentioned margin and leverage, because these are terms that are more used for trading, because we are pushed in every possible direction, especially the online platforms, to do that, as well as many finfluencers that are sometimes good, not very often, objectively. So when you talk about margin or leverage or whatever, it's about short-term trading. Short-term trading, we mentioned savings and investment. There is also, let's call it speculation. This is the idea where you take a position and you expect an immediate outcome. Typically, it can be from technical analysis. There are some patterns. So you say, okay, if this, I don't know, if oil touches this level, then it should go lower. So you take a position to benefit from that. It's a very difficult exercise. It requires immense focus and discipline, because if things turn wrong, you have to cut your position. And you mentioned leverage and margin, because typically these people, and that's what many hedge funds do, they don't try to make, they are not playing a 20% increase in the oil price. They are playing a 1% increase, but they are multiplying it by 20 because they borrow money to take their position. So if you're wrong, you can lose much more than your initial money. And that's not I think that's not the priority for most of us, including myself. I mean, individual investors. I think the priority is to understand the asset classes, time horizon, and how to benefit from these asset classes in a portfolio.
Let's talk a little bit about market conditions. Now, we often hear the term bear market and bull market. What are the differences between the two, and what should people be aware of when, trading or buying or investing whenever there is a bear or bull market?
Okay, so first, the fundamentals. The bull market is positive when it goes up. Bear market is negative when it goes down. I have nothing against bears, and bulls are a dangerous animal, but that's how it is. So bull is bullish, is you go up. Then you have, again, markets follow phases and cycles. It's a reality. And you have different time horizon. You have a long-term horizon, which is we usually called secular, which spans around years and sometimes decades, usually around the big transformational event. We have had several secular bull markets in equities, typically. The secular phases, you capture them through what we call the strategic asset allocation, which is how you build your portfolio if you don't have any view on what's going to happen this year or next. So bottom line, yes, markets have phases, which are bull or bear market. The most important are certainly the secular ones.
So what are signs that could indicate that either a bear or a bull market is approaching?
From a secular point of view, you have very slow-moving things that we look at, especially the inflation or the ratio between the market capitalization to the size of the economy, these kind of things. And it's mostly regime changes. Again, the secular trends, there is a reason. The end of World War II. I mean, it was a reason. Again, the appearance of the internet, maybe AI. You have a big shift. You have a regime change. For the cyclical ones, it's about you look at the economy, and it's not just what happens. Let's say the economy, growth, inflation, and central banks. That's what matters. It's not just about what happens, but it's also what happens compared to the expectations. So, what will trigger a bull or a bear market is whether there could be a difference between these implied expectations and the reality.
I'm going to move a little bit toward people's behaviors. How important do you think a person's mindset is when investing?
Let me start by the fact that emotions are not your friend when it comes to investing, not at all. And both ways. Overexcitement is not your friend, and panic is even worse. And you have to get prepared to the fact that you have zero control, especially on what happens on the short term. So the mindset should be definitely about defining a long-term horizon, a discipline, and sticking to it whatever happens. When it comes to markets, you can be very unlucky or very lucky at the beginning. It doesn't change the long-term outcome that much. It's not that important. So the mindset is really about first being very clear about what you want to achieve. And again, when I say that emotions are your enemy, it's difficult, especially as you have many people on social media or whatever that will tell you that you can get rich very quickly and that it's simple. There is a method for that. It's not true. Yes, you have a few geniuses that I was mentioning, but if there was a method to get rich quickly, these guys would not be selling, training. They would just make money, and they would have been hired by hedge funds, and this would have disappeared, because even if there was a method to make short-term money, all the hedge funds would do the same, and this would disappear because it would be done. So there's none. So the mindset is, first, you have no idea of what is going to happen in the short term. Forget the prediction or whatever. Second, your emotions are not your friend, whatever they are. And third, the most important is your time horizon.
So be realistic as well, right?
Yes, you can dream or whatever, but Einstein said that compound interest is the eighth wonder of the world. You wouldn't believe if you make 7% per year. It doesn't make you dream if I say that, but you double your capital every 7 or 8 years. So it means that over 20 years you multiply it by a very serious factor.
Can you elaborate a little bit on the concept of compound interest?
Oh, it's very simple. It's the idea of reinvesting the money you make. So let's imagine you make 10% for simplicity. You invest 100. At the end of the year, you have 110. At the end of the second year, the 10% apply to this 110, so you have 121. And at the end of the third year, you have 134, let's say, roughly, and you continue like that. At 10% over less than 7 years, you double your capital, and it's exponential growth. And Einstein as well was not known for his investment skills, but was an absolute genius. Also said that if you don't understand the power of compound interest, you are the one who pays for it. And it's a very powerful thing.
What advice can you give people who don't have that, experience with investing? How can they basically filter out the noise to know what investments they should do versus the ones that are just noise on the internet?
It's about the intention. Some of them are very interesting. There's no question. It's always good to look at things. What I don't like is that when people tell you that you can learn how to become a successful trader, you know this kind of post where the guy is in front of his Lamborghini and whatever, and will tell you can do like me, and it only will cost you $100. This just run away, click elsewhere. There's no doubt. But if somebody is telling you about building wealth over time and say, why you should save your money and have an emergency fund, and then buying a home could be a good idea or not, that could be very interesting. And the beauty of the age we're living is that you have access to amazing quality, amazing insight. The thing is that many of these guys, either they want to sell their training, or they want to get audience to have, sponsors or whatever, or worse, it's outright scams like we have seen, especially in the NFT and meme coins sphere. So it's about doing the part. First, if you start by understanding the difference between investment and speculation and trading, for financial literacy, there are many things, and you have access to genuine, amazing investment professionals. So it's about filtering the hype. Everybody will tell you about trading who start by saying it's easy to get rich. Forget, it's not true. It's easy to get rich over 30 years if you save part of your money and you invest it wisely, yes. But speculating on something, no, it's not true. But then you have, I was mentioning Ray Dalio is, I don't know if he's maybe 70 years old now. He continues to write amazing insight. You have Michael Burry, the guy from the the movie The Big Short is a real guy, the guy who saw
Yeah.
the great financial crisis happening. This guy, he tweets and he tells about his position and he say, oh yes, I bought these Chinese companies and whatever. This is amazing inside. Maybe because I'm old, I say don't trust the 18 years old on meme coins, but you have amazing thing. It's just the difference is investing and trading are not the same thing, and trading is very dangerous. It requires discipline and professionalism, while investing is not very complicated. We use jargon and everything, but at the end of the day, the basic principles are not very complicated.
Yeah. I'm going to move on to some, let's say, pitfalls that people face or challenges. What are some common challenges that first-time investors tend to make from your experience?
Yes. It's about not taking into account diversification. And diversification, especially at the asset class level. We go all in. Some people will say, I invest, I will buy stocks and tech stocks in the US because AI is a thing, and it may work. But from an investment perspective, you need to be diversified. And again, it's about the beauty of the various behaviors of the various asset classes. If you have anything more than 5 years in front of you, you should have a bit of bonds, a bit of equity, a bit of gold, and a bit of cash, and that's something that people tend to overlook. Apart from what we just mentioned, being a bit confused between trading and investment. Investment is a long-term game.
We hear risk tolerance a lot. Like when someone's investing, what's your risk tolerance? So, what is risk tolerance, and how can someone, figure out what their own risk tolerance is?
We talk a lot about risk tolerance, and there are very good reasons for that, because if you ask people, what do you want? They will tell you, I want zero risk, but I want high return, which is natural. We all want that. I mean, yes. And that's why these influencers are doing so well, by the way. The thing is that it's not possible. Returns are the result of the risk you take, and it's good to take risk, again, if they are calculated. For me, you reconcile that with your time horizon. That's really the thing. Risk. Let's imagine you start investing and you are very unlucky. Your portfolio is down 10% after 1 month. What is your risk tolerance? If you need your money at this time, you're in trouble. Yes, you shouldn't have done that. But if you have started for 5 or 10 years because it's a long-term project, then you should tell you, it could have started with a plus 10%. The short term is unpredictable. And that's why the risk tolerance is linked to the time when you need your money. I'm not talking about an emergency, which is more about liquidity. You need your money you need to be able to sell if you need it because you have a big issue. But in general, risk tolerance should be at your investment horizon. You don't know what's going to happen in the short term. And if you start with a minus 10 and say, I should have waited, think that you could have started with a plus 10, and then had you waited, you would have regretted it. So just trust the process and consider your risk tolerance at the end of your investment horizon.
What advice can you give people who are starting small or thinking to start small? Should they wait a little bit to accumulate a bit more before investing?
I love this question because we live, again, a wonderful time where you can start small. I encourage people to start small. The reason is that investment has a learning curve, and it's a lot about this control of emotion that we were mentioning earlier. And frankly, it's better to lose 20% on 1,000 dirham when you start than on 100,000 dirham.
That's
and
true.
So you get used to understand, and it's a fascinating. The learning curve is infinite. I do that for 30 years. I learn stuff every day. And it's good to start small, to start early, and to understand how your portfolio behaves. And it's very interesting.
I like that you mentioned starting small is recommended because you want someone to build that confidence for them to, be able to go with the bigger amounts. What are some approaches that people could take when starting small?
The most important thing is your asset allocation, your portfolio construction, a bit of the mix of assets. And the most important thing is diversification. If you're not diversified, you take one risk. So if you're right, you feel like a genius. If you're not, it's miserable. So you want to be diversified. If you start small, You need to have a limited number of products that are low cost, because otherwise, if you have fixed cost or whatever, it will be an issue. And ETFs are fine. ETFs, so these are funds that are listed. So they are on a stock exchange. So you can buy and sell them during the market open hours. It's very easy. And they replicate a broad index with 4 ETFs, frankly, the 4 big families of asset classes I was mentioning. Let's say one money market fund, one global equity ETF, one global bond ETF, and one gold ETF, which works as a proxy for all alternatives. You start, and you can see how it behaves over time. And you can do that, literally with a few thousand dirhams on this platform, these online platforms. They want to push you to trade because they make revenue out of transactions. But it means that all the rest is almost for free. You're not forced to trade all the time, and I would advise against, but you can use this platform because they are fantastic for access to markets, for the trading efficiency, for having real-time things. And I'm going in every direction, sorry.
No, but it's great, actually. I think you're really like giving that broader perspective on how to look at things. Let's talk about different trends. You know, there's a lot of trends that go out that they say you have to invest in this now, or, you know, or you'll miss the boat, let's just say. Mm-hmm. How can someone determine what's a trend and what's an actual good investment opportunity?
That's a brilliant question, because for sure we can identify mega trends, things that are changing, and of course the elephant in the corridor is AI. There's no doubt the race for AI is real. The world economy needs productivity. Then how do you turn this identified trend into an investment? Who makes money with AI? And it's not just about who makes money with AI, but who makes money with AI without being too expensive as a stock and as a company. And in this case, that's probably when you need an advisor to tell you, look, in AI, at this stage, we are in the capacity building phase. So people who use AI, they don't make money out of AI. They just use it. But the people who make money are the ones who provide the chips, for example, or even even more nuanced people will tell you, AI, money is made by the chip makers, but the stocks are expensive, but AI requires energy. So let's look at the utility companies that provide electricity, the people who do the smart grids that will provide energy to the data center. And that's where you need an advisor.
Let's say someone's invested and they didn't diversify as much as they should have, and they lost their investments. Yeah. How can they emotionally prepare for starting up again?
Oh. You have to avoid any denial, and you have to embrace your mistakes, because that's how you learn. And by the way, we don't live in a world of wisdom. We professional investors, we are wrong at least 40% of the time. It's a very peculiar job to that extent. Imagine a hairdresser that misses 40% of the haircuts. You would be out of business. Yeah. With 40%, you are among the best in the world. Really, you make mistakes all the time. It's about embracing them, facing them, and say, okay, what went wrong? Yes, I bought only NVIDIA stock. That was my problem. Or I thought that the dollar was down and that it could only go up, and I put some leverage, while at the end of the day, face yourself in the mirror. Do I know where the dollar is going next month? I don't. So restart by embracing your mistakes, and each mistake is a step toward learning, and we learn every day. Including investment professionals, and I do that for 30 years. I know many people who do that for decades. You learn every day. That's the thing, and that's also why I encourage people to start small. You lose 80% on 1,000 dirham, you probably won't be dead. And it's good, But don't speculate. Don't try to get rich quick. It doesn't work.
What about people who are starting to invest and save in their 30s? And they feel the pressure to, like you said, you can't be investing to get rich fast, but they feel that pressure with their timelines. What advice can you give to them when it comes to investing?
When you're in your 30s, again, it depends on your goal. If you're in your 30s, you start investing because you want to have some money in the... when you're 60, it's a wonderful time to start and just buy equities every month. I don't think there's any pressure. The issue is that, it's not taught in school, and we learn to do, we invest much more in learning how to drive than learning how to run your money, even from budgeting and whatever, while it is very important.
Very
you can
important.
live without driving.
It buys your car.
Yeah.
Yeah.
And so I understand the pressure, but if the pressure is about, I must save money, welcome. You're in your 30s. You have 20, 30 years, invest in equity every month.
I think it goes back to mindset again, right?
Yeah.
Yeah. If you were to wrap up this very insightful conversation into, let's just say, 5 key points, what would those 5 key points be?
First, it's about the investment horizon. Definitely, that's what matters. Second, nobody knows what will happen in the short term. Third, diversification is absolutely everything. If you have the right investment horizon, you can make an asset allocation. And then forget about risk tolerance, short-term timing, whatever. Fourth, you can start small. There's absolutely no issue with that. And even it's a good thing. You can have access to a wonderful investment. And for the 5th one, the magic is in the long term. And the 6th point is that it's a fascinating area, fascinating to learn, because markets are a window of the world. Everything that happens on this planet have a market impact, and the learning curve again is infinite, very steep at the beginning. So build your portfolio with 2,000 dirham, 4 ETFs. See how it works, how they evolved one against the other in absolute. Make some mistakes. Not a big deal. That's how you learn, and it's fabulous.
That's good. So you got 6 instead of 5, but I'll let it slide.
I hope you wouldn't notice.
I'm going to go to my last question.
Mm-hmm.
What is
pressure.
wealth? Yeah, a lot of pressure. What is wealth to you outside of money?
Oh, that's a brilliant question. Wealth is freedom. That's as simple as that. Your wealth is the ability to leave a job you don't like, to make gifts to people you love, and at the end, this freedom and the ability to. Life is about love and freedom, I think, at the end of the day, and wealth gives you options. That's as simple as that, and that's why it's important, and that's why we take our business very seriously. We take care of people's future. We have people's freedom more than just wealth.
So it's like a passion to you, your job, which is
100%,
lovely.
I love it, yeah.
Honestly, Maurice, thank you so much for the conversation and for the insights that you shared today. I think that, you really broke down a lot of complex topics in a way that our listeners can, digest very easily and hopefully make the right, choices for their future.
Thank you very much for having me. It was a pleasure.
Remember, investing isn't just for the wealthy, it's for everyone. It's a mindset, it's a habit, and most importantly, it's a responsibility to your future. So start today, start small, and be consistent. Stay tuned for the next episodes, and I'll see you then.